Welcome to our shareholder restructuring proposal for Regeneron. Our group consists of Ritwik, Head of Quantitative Analysis, Thomas, Head of Qualitative Research, Yash, Head of External Relations, along with Yazmin, Senior Associate, and our analyst, Anne. We will share our proposal to alter Regeneron's capital structure through the issuance of debt and the repurchasing of equity. Our proposal consists of £6.207 billion debt issuance alongside the £2.5 billion equity repurchase, which is required for Regeneron via its pre-existing agreement with Sanofi. Regeneron benefits from multiple revenue streams with medicines and pipelines including, but not limited to, eye diseases, allergic and inflammatory diseases, cancer, cardiovascular disease, infectious diseases, and rare disease. In 2012, Regeneron announced its development of a cholesterol-reducing drug in partnership with Sanofi with over 72% reductions compared to competitors. In 2015, the development and commercialization of new immuno-oncology drugs was announced, estimated to generate $2 billion in revenue for Regeneron. In 2017, Regeneron faced some negative public reaction, however, as Regeneron formed a deal with the US government that meant the government funded 80% of a new antibody treatment. The negative public view can be seen in the sharp decrease in share price from 2016 to 2018. The deal was under heavy scrutiny by the New York Times, as the deal was crucial for Regeneron's COVID vaccine development, earning them lots of revenue. We can see that historically net debt has been negative for Regeneron and leverage ratios have been low. Debt to equity was only 0.24 in 2020 and debt to EBITDA is still below 1. The overall leverage of the firm, or net debt to capital, was 19.6% in 2020. This was after a restructuring that occurred in 2020 with Goldman Sachs as the lead bookrunner, where there was a debt issuance of $1.5 billion alongside an equity repurchasing of $2.5 billion to raise leverage levels in the company. Pre-2020, the leverage figures were even lower. Moreover, Regeneron was sufficient cash flows to meet its short-term obligations too, as shown by the cash and quick ratios that have remained above 1 from 2015 to 2020. All these signs indicate that Regeneron is ready to take on more debt or repurchase even more equity. Looking at Regeneron's future debt obligations on the right, Regeneron only has $2.7 billion outstanding debt comprised of 4 issues, of which $750 million is due in 2022. This repayment has been accounted for in our forecast. GSK, in comparison, not only has more debt and debt issuances, but a shorter average weighted maturity of 7 years opposed to Regeneron's 12 years, showing a comparison between the two pharmaceutical companies. We would have supported the ratification of the appointment of PwC as the independent auditor for the fiscal year, as PwC is a leading auditor with an extensive track record. Moreover, we take faith in the fact that a vote for the ratification of PwC is not an obligation and was only done so as a matter of good corporate governance by the board. With regards to the election of the 4 Class 3 directors, we would also have voted in favour due to the extensive experience of the 4 proposed candidates. Dr. Mark Tessier-Levine has served as president of Stanford since 2016 and is a member of various national academies and royal societies. Dr. Tessier-Levine has also served as a board director of Pfizer, Agios, and Juno. Anthony Coles has been with Regeneron since 2017 and has extensive regulatory knowledge as well as experience in therapeutics, drug discovery, and CRISPR. George Singh has an unprecedented knowledge about Regeneron, being a board member since 1988 and has been CEO of Gandhi, a biomedical drug company. Arthur Ryan has the financial expertise necessary to help Regeneron, being the chairman of the board for Prudential. Regarding the development of our products, REGEN-COV continued to be used against the pandemic, but also showed strong positive data regarding the treatment and prevention trials. Evkeeza was approved for homozygous familial hypercholesterolemia, Libtayo was granted approval in lung cancer and basal cell carcinoma treatment, and Dupixent was granted as prescription medication under the Prescription Drug User Fee Act. From the 2021 AGM, Regeneron showed 4 strategies to achieve growth, such as exploring gene-based therapy using drugs such as Eylea, which is the #1 prescribed anti-VEGF treatment, and further development of Dupixent to treat asthma.
After applying the assumptions outlined previously, leading to the forecast, we were able to calculate both the unlevered and levered free cash flow using the levered free cash flow as the basis of our DCF valuation. Terminal EV/EBITDA value for 2020 was used, which was at 19.9 times. Levered WACC was used for the discount rate, with the formulas given on the bottom right. Both increasing debt issuances and stock buybacks increased the valuation of the firm, with the valuation being more sensitive to debt issuances. To test which approach would be better, we can compare 2 scenarios. One being where we max out the amount of debt issuances we can have, and 2 being where we max out the amount of stock buybacks we can have in 2021. The maximum values were derived after placing some constraints, such as a cash constraint for equity repurchasing, where the cash balance in the company must not fall below 0 in any given year. For debt, we placed 3 constraints. Firstly, a tax constraint that debt has to be less than or equal to EBITDA over R to D. Secondly, the profitability constraint that the valuation of the firm must not fall below zero. Lastly, an ICR of 7 times, as we are aware that lenders would be reluctant to lend debt to a firm above a rating of BB if the ICR falls below 5. We do not see the need to fix the D/E ratio for Regeneron since leverage ratios are so low, thus bringing us to a maximum debt issuance of £6.2 billion and a maximum stock buyback of £3.2 billion. Both debt issuances and buybacks increase the valuation EV debt by a greater amount. With a £6 billion increase in debt, the leverage ratios are still healthy. Debt to EBITDA reaches a maximum of 2.71 in 21, which we can be comfortable with at BBB+. With a £3 billion equity repurchasing, the share price and earnings per share rise by large amounts as expected. Under our debt scenario, the valuation EV is high at £183.3 billion. Debt to equity increases to 0.71, and all leverage and liquidity ratios are at healthy levels. However, the share price and EPS fall in the absence of any stock buybacks. We're looking at maxing out the equity repurchase based on our cash constraint, though EPS and share prices face a boost. Cash obviously is negatively affected, reaching zero in 2021. We know from the 21 AGM that Regeneron wishes to increase its cash flow alongside boosting EPS. Thus, we can see that debt issuances are also required. Moreover, the valuation EV does not increase as much as the debt scenario for stock buyback scenario, and the WACC is higher by 190 bips. A third scenario, maxing out the debt issuance at £6.2 billion with the pre-planned equity repurchasing of £2.5 billion, represents our £8.7 billion restructuring proposal, showing a best of both worlds scenario. The valuation EV is higher than if just maxing out the debt or the stock buyback, with the valuation figure being at £186.2 billion. Share price is high, as is the EPS. Moreover, the firm has a high cash balance throughout 21 to 23, and so the equity repurchasing does not take away too much cash from the firm. While profitability, efficiency, and leverage ratios remain healthy, leverage does not exceed 50%, ICR remains comfortably above 7, the cash and quick ratios remain significantly above 1, and the net profit ratio is above 20%. Share price is expected to rise from 644 in 2020 to 861 in 2021, exceeding the minimum share price of 628.41, which shareholders would require to gain from an equity repurchase. The calculation can be seen on the bottom left. An interest tax yield of 1.6 billion and shareholder gain of £3.20 per share occurs at our proposal. The interest tax yield is given by RD times D, and shareholder gain is calculated by the new price minus the old price times the new outstanding shares. Under a downside scenario, our proposal still works well. The valuation EV is positive at £119.6 billion, liquidity ratios remain above 1, and leverage does not exceed 50%. Though ICR falls below 7 in 2021, it remains close to that and exceeds that constraint in the subsequent years. EPS falls in 2021 below 2020 levels, but is estimated to exceed that level in 2022 and 23. £2.5 billion equity repurchase still provides some boost to the EPS. Return on equity and profitability ratios decrease but remain positive. As the biopharmaceuticals industry is highly competitive, it could happen that Regeneron's new products do not sell as well as hoped. When Pfizer announced its COVID pill in October 21, Regeneron saw a 6% decrease in value. The value was fortunately regained when tests showed Pfizer's pill to be less efficient, but serve as a reminder of how revenue growth could possibly slow down. Moreover, in an industry that's so heavy on R&D investment, the behavior of competitors may force an increase in cost than previously estimated. We also tested the individual effect of some key drivers using sensitivity analysis, such as testing the effect of a 5% change from our base case assumptions in revenue and cost on EPS, finding that a 5% change in our revenue growth led to a 4% change in EPS, and a 5% change in our cost assumptions led to an 18% change in EPS. Testing the effect of a 5% change in revenue, WACC, terminal EV to EBITDA using our DCF valuation, with the results shown at the bottom and the chart displayed on the right. A 5% change in revenue led to a 4% change in our enterprise value. 5% overestimation in WACC would mean a 15% overestimation in enterprise value. A 5% underestimation would mean an 18% underestimation of valuation EV. Lastly, a 5% change in our EV EBITDA terminal value would change valuation EV by 5%. And if we were to apply the lower yielding valuation for a 5% change for revenue, cost, WACC, and terminal value assumptions together, our valuation would decrease greatly by 47%, but still be positive at £96.4 billion, and therefore we take confidence in our proposal.